Hello and welcome to the Wisdom Workshop. Please like the video and subscribe with all notifications turned on so that you won't miss any of our wisdom improving videos. Now let us start with the video. Take a look at the mortgage application data we obtained. The buy index was down 8% following a 3% drop that week, while the refinance index was down 9% following an 8% drop the previous week. Mortgages and refinances are falling, which has serious repercussions for the economy. Wells Fargo has announced massive layoffs in its residential lending division because people aren't able to refinance their mortgages, so they don't need all these mortgage brokers if people can't refinance their homes since mortgage rates are only 5% or so. The mortgage interest rate is currently so high compared to where it was that no one can refinance their mortgage into a lower rate since everyone else has a better deal than what they can obtain today. That refinancing lifeline has been a huge lifesaver for the economy since it has provided a source of revenue for people, and also since you only refinance your mortgage if the outcome is a reduced payment and if homeowners can cut their payments through mortgage refinancing. They have more money to spend since they're not paying their mortgage, so they can go shopping or do anything they want, and that increased spending contributes to the economy. It also supports employment in the businesses that benefit from that expenditure. Therefore, this has aided a bubble economy, or an economy reliant on consumer spending. If consumer income is liberated from needing to make mortgage payments, they have more money to spend on other things, which households can no longer do. You won't be able to cut it, and in fact, many people's mortgages will be increasing because there are still a lot of adjustable rate mortgages available. I'm not aware of the precise percentage, but maybe 15 to 20% of mortgages are adjustable, and they aren't always adjusted every year. Many people took out 5-year fixes which adjust after 5 years, and there are many people who did those 5 years ago, and now they're approaching their adjustment period and their rate is going to adjust significantly higher. Now, they'll have to start spending more money on mortgage payments, which means they'll have less money for food and less money for petrol. Of course, groceries and petrol are considerably more expensive, so chances are they'll have to cut back on other luxury goods, which is why many of these consumer discretionary stocks have been struggling. However, we already have circumstantial signs of a weaker economy, with manufacturing difficulties making headlines today. The Kansas City Fed Manufacturing Index was expected to be 39, indicating an improvement, but unfortunately, it was just 25, well below the consensus range. So there's plenty of evidence that the economy is considerably weaker than everyone assumed, especially when you look at the GDP statistic, which verifies this. Now, of course, one of the key causes driving the GDP down was America's historic trade deficit. We actually received the merchandise trade deficit, now known as the goods deficit, and we received the advance approximate, so this was the final month of the third quarter, and this definitely weighed on the number. This is simply products. It does not include our excess in operations, which lessens the total deficit. But this is the important thing. This is manufactured goods. Remember when Donald Trump ran for office to make America great again? It was because of our merchandise trade imbalance. He campaigned to make America great again by rebuilding our industrial base and manufacturing because we were losing trade due to these large trade deficits. Not only did it not shrink as projected, but it exploded to $125 billion, smashing the previous record set far over the consensus range of $103.7 billion to $106.6 billion. This is a horrifying statistic. Nobody has ever seen anything like it. The only thing more astonishing than this number is the market reaction because the dollar rose. I mean, once upon a time, a number like this, which we've never seen before, would have destroyed the dollar, but instead, it rose. Gold got decimated, nothing that should have occurred transpired, and the markets are still absolutely dumbfounded as a result of this news. Normally, the currency of a country with such a massive trade imbalance would be docked because it's the only way to eliminate the gap. When your currency falls in value, you can no longer afford all of your imports, and your exports become much more affordable to foreigners, which helps bring your trade back into balance. However, because we have the reserve currency, the United States of America is not disciplined in the same manner that other countries are. You see, we paid for $125.3 billion worth of imports with dollars. We purchased goods and exported dollars. Dollars are America's most valuable export, but they have no value since we print them and manufacture them out of thin air. The stuff we're getting has actual worth. You need factories, tools, labor, territory, and all kinds of things to make the completed items that Americans import. So why do we give our trade partners numbers we make up out of thin air? What is the world doing with all of this money? What are they gonna do with the $125 billion they just earned? I mean, I know what we're gonna do with everything we just got. We're gonna enjoy it, have fun, and use all of these items to make our lives easier, but what is the world gonna do with all of this money? They're gonna keep it and purchase more of our dollars, but the more they acquire, the less is its value. Right now, the dollar is profiting from this flight to safety from troubles in Europe and Japan, but this is a massive bubble that can only end in tragedy. The higher the dollar goes, the more dramatic the crash will be once reality sets in. When do you believe the market will reach a tipping point, as the newest data shows that new mortgage applications are down by 40% or more and the market will begin to fall? According to the International Monetary Fund, interest rates should be at least 1% higher than the inflation rate, which means that if we're at 8% presently, our interest rates should be at least 9%. I'd like to earn more than 1% over inflation since 1% isn't a good enough return. After all, there are negative interest rates elsewhere. I believe they're the most negative here in the United States of America because we have the most inflation, so even though we have higher nominal rates than Europe or Japan, we have lower real rates because our inflation rate is greater. And of course, that's the unofficial rate. The true inflation rate is far greater. But look at mortgage rates, which are already back up at about 5%, which is historically low but has been well below 4% in recent years. People were obtaining mortgages for less than 3.5% on 30-year fixed mortgages, and if you look at home prices, they're up like 20% year over year, and housing affordability is at an all-time low. And that's before interest rates rise, so the only thing keeping these overpriced homes marginally affordable is the low mortgage rates. But if those low mortgage rates are removed and mortgage rates rise to maybe even 7, 8, 9%, which was normal before the 2008 financial crisis, something has to give, because otherwise, nobody can afford to buy a house. And what will give our property prices, which will plummet, and what will not happen is new construction since inflation is driving the cost of building new homes through the ceiling. So we're not gonna get any new homes. If you want a home, you'll have to purchase one that already exists. However, if you don't have any money and someone wants to sell you a house, the price will have to go down. At some time, real estate may become an all-cash marketplace since most individuals may not be able to obtain a mortgage. But when do you think the Federal Reserve System's interest rate will be so high that it will actually bring down the markets and the economy? I believe that the markets will soon have to accept the truth that the Federal Reserve System will lose the inflation struggle. It may not even have the guts to fight inflation based on the short-term political sacrifices for the economy, employment, and the federal budget deficit. Because if the Federal Reserve System battles inflation, the US government will be obliged to drastically reduce government spending, including spending on social welfare, Medicare, and other programs. So to avoid having to make those difficult decisions, the Federal Reserve System is likely to abandon this policy and return to quantitative easing, with the Federal Reserve System dropping rates again even as inflation stays high. However, when markets recognize that inflation is not going away, even if we have a recession, inflation will not go away. Many individuals believe that if the Federal Reserve System does not win the battle against inflation, a recession will occur, because the Federal Reserve System will raise interest rates high enough to produce a recession, and the recession will eliminate inflation. It won't, because the recession will increase inflation since there will be less economic production, but we will print even more money. But when the markets realize how high inflation will be, there will be a rush towards gold and silver like you've never seen before. Prices will rise rather than fall. Thank you very much for watching our video concerning the frightening issue of the mortgage crisis. Please do like the video if you learned something new and subscribe with all notifications turned on so that you can see more videos in the future concerning the recession.